Hey guys, this is RG and I'm back with another video. I'm bringing you a 2020 crash portfolio update. Please keep in mind that this portfolio includes some of the riskiest companies out there. This is really my speculative portfolio. Keep in mind that when you speculate, that's not conventional investing. What you're doing really is you're gambling. So that's just a disclaimer. I'm not an investment professional or an expert when it comes to stocks. So please just keep that in mind. Nevertheless, I wanted to bring you an update, let you know what I'm thinking. But before we get into that, I wanted to get into some of the stories that have materialized over the last week or so. You know, a lot of what's happening as we move forward is going to ultimately dictate how I decide to play this portfolio. So before I get into the update, let's get into some of these stories and I'll provide you some of my thoughts. So this is the one item that I really want to talk about today, and it's basically interest rates or negative interest rates. President Trump has been attempting to encourage Jerome Powell to lower the federal funds rate into negative territory. Jerome Powell did release a statement this week where he basically indicated that the Federal Reserve would not be lowering interest rates into negative territory, although the markets appear to be pricing for it. For a long time, there's been a lot of discussion regarding this, and the big question is, will we go into negative interest rates or not? A lot of the big central bankers have indicated that we will not be going into negative interest rates for the time being. However, I think that if there's all of a sudden decline in the stock market, I think that they're going to jump in and they're going to try to save the market by going, at least 50 basis points negative. It wouldn't surprise me. But I want to talk a little bit about negative interest rates and how it actually impacts the average consumer, because I think that there's a lot of very serious misconceptions out there. I'm actually surprised by some of the things that people are saying. So I want to quickly talk about them just because I think that there's a lot of confusion and a lot of misunderstandings. I've been researching negative interest rates now for probably the last 5 or 6 years. Keep in mind that there's already countries out there, countries like in Europe and Japan, for instance, where they've been dabbling with negative interest rates. And so there's a lot of information out there, but it seems like now all of a sudden it's becoming a big issue here in the US. Now, before we discuss negative interest rates, let me just give you a quick update. So for the week, we're down about 8%. This was a tough week. Early in the week, there was a lot of significant decline. So real quickly, JLL, Tapestry, Delta, Dave & Buster's, Capri, General Electric, US Bank, Royal Dutch Shell, Wynn, and Discover Financial, as well as American Airlines, were all down over 10% in just 1 week. Again, this is what happens when you engage in risky stock picking. Okay, so these stocks are down. Obviously, people are beginning to get very bearish. My thought process from the very beginning is that I think that we're going to at least somewhat retest the lows. I don't know if we're going to get all the way down to whatever the Dow was at, 18.5. I think that the stock market will head lower. And so I think that a portfolio like this is incredibly risky. Nevertheless, keep in mind that I typically put about $100 a week into this portfolio. It's a very small proportion of my overall net worth, so I'm not really all that worried about it. If I put $100 a week every week, it would only be about $5,200. And to be honest with you, it's just a very small proportion of my overall net worth. So I like speculating a little bit. I've put these stocks into this portfolio because I thought that these were some of the hardest hit stocks. And I wanted to see what this portfolio would do as a case study. What I want to do is I want to chronicle the performance of the portfolio through this channel. That was really the purpose of this portfolio. I am not recommending that you invest in any of these companies. They are very risky. So please do your own research, but feel free to comment if you agree with some of the stock picks here. If you do not, feel free to do so, but just keep in mind that this is a speculative portfolio. So overall, we're down 7% for, I think we've had this for a total of 3 weeks. Now, what I really want to talk about today are interest rates, or better yet, I guess, negative interest rates. So there's been a lot of headlines lately regarding negative interest rates and what they would do to the economy. And so I wanted to talk about this a little bit. So this week, Donald Trump made some headlines just because he was talking about negative interest rates. He referred to them as a gift. He seems to be wanting or encouraging the Federal Reserve to dip into negative interest rates. But before we get into that, I wanted to kind of quickly talk about what that means, because I think a lot of people all of a sudden believe that they're going to be getting negative interest rates associated with their consumer loans, whether it be credit card, car loans, mortgages, student loans. And so I think that there's a lot of misconceptions revolving negative interest rates. And so I quickly wanted to talk about this. So when people refer to negative interest rates, what they're referring to is the federal funds rate. They're not necessarily referring to the rate that you would pay for your student loan, your car loan, your mortgage, or your credit cards, or whatever other type of consumer loan or consumer credit that you may have. So I think it's important to understand that. Nevertheless, the federal funds rate is basically a monetary policy tool that the Federal Reserve uses in an attempt to stimulate the economy during an economic downturn. If you look at the chart, back in July of 2007, we were heading into the great financial crisis, and so the Federal Reserve lowered rates from 5.25 all the way down to basically what we would call today 0%. And so rates stayed at 0% for a really long time in an attempt to generate economic activity. Now, as the economy started to recover, the Federal Reserve started to slowly, incrementally raise rates. So as you can see, the rates creeped up all the way to about 225 basis points in the summer of 2019. And as we started to struggle with the economy again, they decided to start to cut rates. And obviously, at this point, rates are back down to what people would refer to as 0% interest rates. Now, just because we have 0% interest rates, it doesn't mean that you're going to pay 0% interest on your credit card or your student loan or your mortgage or your car loan. So it's important to understand that. Now let's look at online savings accounts. Currently, there's plenty of savings accounts out there that are yielding well above 0%. A lot of your brick and mortar banks are going to be offering basically 0% savings accounts, but a lot of the online banks are offering rates that are well above that. So let's take this Capital One figure into consideration. Currently, Capital One is offering a 1.5% savings rate on a savings account. If the Federal Reserve was to go into negative territory and they went into a negative, let's say that the new federal funds rate was negative 1%, what that would mean is that this rate here would probably drop by about 1%, which means that instead of paying 1.5%, it would probably end up paying about 0.5%. Credit cards would be impacted very similarly. So for instance, back when the Federal Reserve was lowering the federal funds rate by 25 basis points, in other words, by 0.25%, what would happen is I would get these emails from my banks telling me that my interest rate associated with my savings account was dropping. And so if my savings account interest rate was at 2% and the federal funds rate was dropping by 25 basis points, what would happen is my savings rate would go from 2% to 1.75%. So keep that in mind. Now, for those of you who have savings accounts that are already at 0% interest, a lot of you may be thinking, well, if the federal funds rate dips into negative territory, won't that drag my savings account into negative territory? And the answer to that is theoretically it should. However, the likelihood of that actually happening is it's basically 0%. I don't think that any savings accounts out there are going to end up experiencing negative interest rates anytime soon. And the reason for that is because a lot of people know out there, a lot of bankers and a lot of central banks know that if savings accounts were to go negative, a lot of people will end up just withdrawing their money from the bank. And the reason people would withdraw their funds from the banks is because nobody would want to take a negative interest rate, which would basically end up kind of creating like a run in the bank. I mean, think about it. If you got an email today telling you that all of a sudden you're going to get a negative 1% return just for depositing your money in the bank, you would probably just head down there and request to withdraw all your funds. Or what you would do is you would end up transferring your funds to a bank that wouldn't be trying to give you a negative interest rate. So please keep that in mind. Now, the last thing that I wanted to talk about are mortgage rates, just because I think that there's a lot of misconceptions. I've been hearing people talk about them potentially getting a mortgage that has a negative interest rate associated with it, and the likelihood of that happening, again, it's just not going to happen anytime soon. So I wanted to clarify a few things. When people talk about interest rates going into negative territories, they're talking about short-term interest rates. Mortgages, the rates associated with mortgages are determined by long-term interest rates, and long-term interest rates typically, as far as mortgages are concerned, are really determined by the 10-year treasury. I've been looking into this for several years now, and so a lot of experts claim that typically if you want to determine what your 30-year fixed rate mortgage rate should be, that you typically have to add about 2 percentage points to the 10-year treasury. Now, regardless of that, again, I don't think it's that important. I don't want to get into all the specifics. Now, mortgage rates are currently hovering at between 3.2 and 3.3%. So please just keep that in mind. Even though rates are at 0%, that's a short-term interest rate. And you're still going to have to pay a real interest rate out there associated with this. Now, there are also people who have been talking about negative bond yields. So keep in mind, when people talk about negative bond yields, they're talking about government bonds. And so they're saying that a lot of these bonds are yielding a negative interest rates. So for instance, if you got a 10-year government bond at -1%, and let's say you bought a $100 bond, what that means is that you would end up losing 1% of your money every year for the next 10 years, which means that the ultimate payout of the bond would be $90. So a lot of people think, oh, I'm buying a $100 bond, and then at the end of the 10 years, I'm going to end up getting back $90, which would result in a negative return on that bond. But I've been doing research on this, and based on my research, that is a complete misconception. Now, years ago, I did see an interview with a investor that invests in European and Japanese government bonds, and he laughed at that idea. He basically said no one would pay $100, or no one would pay face value for a government bond if it was going to yield a negative return. He goes, that's not the way it works. He said, what people do is they end up paying less than the face value associated with the bond. So in that example, let's take that example one more time. If you had a government bond that you were going to buy for $100, and that bond was going to yield a negative 1% for 10 years, that means that you would end up getting a negative 10% return on that bond, which means that your principal payout at the end would be $90. But what this investor was basically claiming is that that's not the way it works, because what would happen is that you would never pay $100 for that $90 bond. So if you had a government bond that had a face value of $100, which was going to yield a negative 1% for 10 years, and the ultimate payout associated with the bond was going to be $90, a prudent investor wouldn't pay $100 for the bond. A prudent investor would pay considerably less than $90 to still assure a return on that bond. And that's the one thing that I think a lot of people don't understand about interest rates. What you're basically doing is you're paying less than you should for that bond, so you're still guaranteeing yourself a positive return on that bond. But I think a lot of people may not understand that. So it's something to keep in mind. Nevertheless, the most important thing about this video today is I wanted to just clarify that no one's going to be getting negative interest rates anytime soon in the real world. This negative interest rate policy is just an attempt to get you to take your money out of savings accounts, to take your money out of bonds, and it's an attempt to force you into real assets. Now, it's possible that some people may end up getting impacted with a negative savings rate, but I still think at this point it's very unlikely. I also think that it's unlikely that anybody out there's actually getting a negative return on a bond, just because what you're doing is you're paying less than face value for that bond. The one thing to keep in mind is that negative interest rates are not really going to be impacting the average consumer. Nevertheless, investors will be forced into risk assets, because that means that a lot of their government bonds and a lot of corporate bonds are going to be trending down lower, and so people are going to be getting lesser and lesser returns as part of bonds, and so they're going to be forced back into risk assets, which usually means stocks and real estate. So that's going to do it for this week's 2020 Crash Portfolio Update. We are down over 7%. It's been about 3 weeks. As part of this, now all of a sudden I see the stock market coming back down a little bit. The sentiment has become relatively bearish all of a sudden. I think stock values are beginning to trend downward. And as that happens, I'm going to be looking to change the composition of this portfolio and hopefully add better names as part of it. There's a lot of risky positions here, and ultimately I'm looking to include better positions. Some of the stocks that I'm eyeballing right now are Walgreens, JP Morgan Chase, and Wells Fargo. Those are 3 stocks that have gone down considerably. 2 of them are in the financial sector. Financial sector right now is very, very risky. Ultimately, I think that a lot of these stocks are going to be heading lower. So let me know if you're making any speculative buys. Again, I don't recommend this overall. This is a very small portion of my overall net worth, but I'm not advocating that you take the same investment approach as what I'm doing here. That's going to do it for this week's video. Please feel free to comment below. Let me know also if you guys have any comments or would like me to do any videos on any things that I discussed today, such as rates, negative interest rates, inflation versus deflation. I really love kind of the macroeconomic side of the stock market. I think it's important to understand that in order to make good, sound, solid investments. Again, keep in mind that what I'm doing here is really just speculation. So it's something to keep in mind. I have a wide variety of other investments that are good, sound, solid, conventional, non-risky investments. I'm a relatively conservative investor, but I do like taking chances, and I do like allocating a small proportion of risk into my portfolio. I think that risk is part of any portfolio, and I wanted to do something, document it, and chronicle it as part of this channel. Nevertheless, that's going to do it for this video. Please feel free to hit the like button if you guys enjoyed the content. Subscribe if you like, and I'll see you guys on the next one.